In prior videos, we discussed stocks and bonds and how they are fundamental investment vehicles. But the two are by no means comprehensive of the investment universe. There are many other instruments out there. Some are straightforward, while others are so complex, we still don't fully understand them. Intrigued? We'll dive into the topic and more on today's Plain Bagel. The world of investments can be categorized into two high-level groups: traditional investments and alternative investments. We've covered most of the traditional investments, which include our standard stocks and bonds, but there's one other security included that we need to touch on: the cash equivalent. Cash equivalents are a broad group of instruments that are deemed highly liquid, meaning that they can be easily and quickly converted to cash by the investor if they need to get out of their holding. These investments are typically issued by financial institutions, often have a stated interest rate paid to the investor, and are fairly low risk. One of the most common cash equivalents utilized by first-time investors is the savings account, which, as you probably know, is a bank account that gives you small, regular interest payments on your cash balance. Savings accounts are easy to set up, and though there are some restrictions, typically allow you to withdraw your money at any time. Additionally, in Canada, savings accounts are backed by the Canadian Deposit Insurance Corporation, which adds a layer of security to your money. Another common cash equivalent, similar to savings accounts, is the Guaranteed Investment Certificate, or GIC, which is a security that pays you an interest rate but locks in your money for a period of time. GICs often guarantee that your investment won't fall below a certain level. So although it pays a higher interest rate than savings accounts, their returns are still on the low end. Finally, cash equivalents also include a full subcategory of investments known as money market instruments. These are a vast group of securities that act very similarly to bonds, but typically have maturities of less than a year and often only pay their interest at the end of the investment's life. As you would expect, money market instruments are issued by companies looking to borrow money for a very short period of time, and as such don't offer a huge return to investors. A few examples of these investments include commercial papers, bankers' acceptance, repurchase agreements, and many, many more. Cash equivalents as a whole are fairly low risk, and because they offer a stated interest rate, many investors like to use them when starting off. However, keep in mind that the low return they offer may not be enough to reach your objectives, and could even fall below the annual inflation rate. However, cash equivalents are a great way to invest excess cash while maintaining some flexibility. So, cash equivalents along with stocks and bonds make up our traditional investments. You can think of alternative investments as representing the other category, encompassing basically everything else. So, let's go through a few of these alternatives. First up, we have real estate. Real estate as an investment category can refer to both commercial buildings, such as office buildings and shopping centers, or residential buildings, such as apartment buildings and housing. Though it may not be immediately apparent why the house you live in is considered an investment, there's a reason people can make a living off of buying and holding properties. You see, real estate offers two sources of return. Firstly, the value of real estate tends to increase over time. This is because land is a finite or limited resource, while demand for land typically increases with the population. So as more and more people inhabit an area looking for property, land, and therefore your real estate becomes more and more valuable. In addition to this capital appreciation, some real estate owners rent out their property, which earns them a regular rent or lease payment, in the same way that stocks and bonds provide you dividend and coupon payments. This sounds great and all, but chances are you don't have the small fortune required to purchase, let alone operate, a commercial or residential building. And putting all of your money in a single building can be risky. If the building gets damaged, or if the area surrounding the building makes the area unattractive to tenants, then you could lose some money. But we can navigate these issues through something called a real estate investment trust, or REIT. REITs are companies that own and operate a portfolio of properties. They collect rent and lease payments from their properties and then pay a high portion of it to shareholders via distributions. This allows investors to gain exposure to real estate without investing significant sums of money or requiring any operational expertise. REITs additionally face favorable taxes and allow investors to have a small stake in a number of buildings as opposed to a large stake in one. You can also gain exposure to real estate on the debt side of things through something called a mortgage-backed security. A mortgage is a loan provided by a financial institution for the purchase of a property. And similar to a REIT, a mortgage-backed security is an investment instrument that purchases or lends a number of mortgages and then sells shares of the pool to investors. When the mortgage borrowers pay the interest on their loan, it's added to the pool and then divvied up amongst the investors holding shares of the MBS. So, there are plenty of ways to invest in real estate. But what else is included in the alternative investment universe? Well, one that's followed very closely by companies and analysts around the globe is commodities. Commodities refer to metals, minerals, agricultural products, and other raw materials, such as oil, wheat, and gold. These goods are inputs used by companies to create their own products. For example, wheat is used to make food, while oil is used for fuel. But investors purchase commodities with the assumption that they will be able to sell them in the future at a higher price, because of both inflation and supply factors. For example, since gold is a finite resource, it should theoretically increase in price in much of the same way as real estate. So holding on to gold should earn you a return. Investors also believe that some commodities, namely gold, have safe haven properties, meaning that they are somewhat immune to stock market downturns, though that has not always held true. Commodities are a huge part of the alternative category. But again, there are a few problems you'll run into trying to buy and hold commodities. They are a physical product. So if you wanted to invest in gold, for example, you'd have to somehow organize moving it, storing it, keeping it protected. It's clear that most investors aren't equipped to handle these issues. This and many other investment limitations has given rise to one of the most revolutionary alternative investments to date, the derivative. Derivatives are investments that derive their value from an underlying asset. They come in a variety of forms, including options, futures, swaps, and so on, but they all follow the same idea. Now, this is a bit of an oversimplification, but when you buy a derivative, you are essentially taking a bet on whether the price or rate of something will increase or decrease. Once you make your bet, your derivative investment will gain value if you are correct, and will lose value if factors move against you. So why do investors use derivatives? Well, they can help you do a number of different things. Firstly, they can be used to mimic the return of something, like a commodity, without actually owning the investment. For example, you could simply bet the price of gold will increase, and more or less copy the return you would see if you were to actually own and sell the gold. Derivatives are also used by companies to hedge or limit their risks. For example, imagine you are an oil company that will go bankrupt if oil falls below the price of $50 a barrel. You could use derivatives to essentially bet that oil prices will in fact fall below $50. Why would you bet against what you want? Well, if the price of oil does go down, then your bet will gain value and could be used to offset the losses you've incurred from your business. This of course means that if the opposite happens and prices go up, you'll miss out on extra profit since you'll owe money on your derivative. But it may be worth it for the business to hedge away the risk. Derivatives may sound simple enough, but they're actually very complicated to analyze. Most pricing models rely on oversimplified assumptions, and some derivatives don't have a price until after they've been sold. And yet it is thought that the derivatives market is 10 times the size of the global economy. Pretty crazy for something that doesn't actually involve investing in the markets. But with that said, we've now covered our basic investments and some more complicated ones. And there are still other alternative investments that we haven't covered. Private equity and venture capital, for example, are popular investments that allow investors to own startups and non-public shares. But given the breadth of securities out there, you as an investor may not be interested in hand-selecting these individual securities. Some would much rather have their investments picked for them via these things called managed solutions, which include mutual funds and ETFs. But that's a topic for another video. For now, we're out of time. If you like this video, please hit the like button, and if you like what we're doing, please subscribe. If you have any feedback or topics you'd like us to cover in future videos, please leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today.